Imagine walking into your bank, walking up to the teller to withdraw your own money, and realizing the cash isn't there. It's just numbers on a screen. The vault is empty. On December 24th, that is exactly what happened to the global silver market. A glitch in the matrix appeared that wasn't supposed to happen. In Shanghai, on the Shanghai Gold Exchange, people were paying roughly $78 for an ounce of physical silver. At the exact same second, in New York, on the Comex, the price was sitting at $72. That is a $6 spread, a 10% gap, a free money glitch. In a functioning market, that shouldn't exist. Normally, Wall Street sharks, the arbitrage traders, would close that gap in milliseconds. They would buy the cheap silver in New York and then sell it in Shanghai to pocket the difference. That is the law of financial physics. But this time, they didn't. They couldn't. Why? Because the bridge between paper reality and physical reality has finally collapsed. You cannot arbitrage a market when you cannot get your hands on the metal to move it. China didn't just break the silver market. They just proved that the Western financial system is selling you something it doesn't actually have. I'm Robert, and today, we are auditing the fraud. To understand why this gap matters and why Wall Street is terrified, I need to explain the scam that is the Comex exchange, but I won't use boring financial jargon yet. I'll keep it simple. Let me explain the global silver market with a valet parking analogy. Imagine a valet parking lot with only 100 parking spots. That represents the actual registered silver in the Comex vaults, the metal that is actually available to be delivered. Right now, that's about 120 million ounces. But the valet guys, they are greedy. They printed and sold 500 tickets for those 100 spots. How does that work? Well, it works beautifully as long as everyone is eating dinner inside the restaurant. As long as the investors just trade the ticket, the paper contract, back and forth and don't actually ask for their car, the system looks fine. The valet pockets the cash. The liquidity looks deep. And everyone feels rich. This is what we call fractional reserve commodities. It's a confidence game. But you might be asking, Robert, is that even legal? How do they sell 500 tickets for 100 cars without going to jail? Well, they have a fancy word for this scam. It's called rehypothecation. It sounds complex, but it's just authorized theft. Here is how it works in the London and New York vaults. Bank A holds a bar of silver. They lease that bar to Bank B. Bank B lists that bar as an asset and sells a futures contract against it to investor C. Meanwhile, Bank A still lists that same bar as an asset on their books and uses it as collateral for a loan from Bank D. 1 bar of silver. 4 different people think they own it. In the financial world, we call this the velocity of money. In the real world, we call this fraud. For 40 years, this worked because nobody checked the vault. The velocity was high enough that if one person wanted their silver, the banks could quickly borrow it from someone else to fill the order. It was a game of musical chairs. But here is the problem. The music just stopped. China just finished dinner. India just finished dinner. And now, the solar panel industry is walking out the door. They don't want to trade tickets anymore. They want their cars. And when 500 people try to claim 100 cars at the same time, that is not a market correction. That is a riot. The chains of rehypothecation are snapping because you cannot release a bar of silver that is currently sitting on a ship headed to Shanghai. That is exactly why silver is $78 in Shanghai, but only $72 in New York. The $78 is the price of the car. The $72 is the price of the ticket. That turned out to be worthless. Now, before we talk about China's strategy, you have to understand why the West cannot simply dig its way out of this hole. Any free market economist will tell you, Robert, if the price goes up, supply will go up. If silver hits $100, miners will just work overtime to dig more. That sounds logical. But it is dead wrong. Here is the dirty secret of the silver industry that Wall Street ignores. Silver is rarely found alone. Roughly 70% to 80% of the world's silver supply comes as a byproduct of mining other base metals like copper, lead, and zinc. Think about what that means. A miner digging for copper in Chile doesn't care about the price of silver. Silver is just the bonus dust they find while looking for the copper. This creates a terrifying economic paradox known as inelastic supply. Imagine this scenario. We are entering a global recession. Construction slows down. The demand for copper, for wiring, and zinc for steel crashes. Miners stop digging for copper because nobody is buying it. Guess what happens to the silver supply? It crashes too. Even if silver is skyrocketing to $100 an ounce because of solar panels, the miners cannot dig more silver without digging up mountains of worthless copper that nobody wants. So we are facing a perfect storm. Demand is exploding due to green energy. Supply is trapped because it is tied to the slowing old economy. Supply cannot react to price. This is why the shortage is structural, not temporary. We are running out of the byproduct just as we are becoming addicted to the product. So supply is stuck. But where is the existing metal going? It is flowing to the one player who decided to change the rules of the game. China has recently reclassified silver under its dual-use export control rules. Pay attention to the language. They didn't ban silver. A ban is clumsy. A ban makes headlines. A ban starts a trade war. Instead, they labeled it strategic. By classifying silver as a dual-use material, meaning it has both civilian and military applications, China has effectively created a bureaucratic kill switch. Starting around early 2026, exports will require specific government licenses. This is weaponized bureaucracy. They can technically say the market is open, while quietly denying every single license application that lands on their desk. But Robert, you ask, doesn't Mexico mine the silver? Doesn't Peru? Yes, they do. But mining is just digging rocks out of the ground. To turn those rocks into the conductive paste needed for solar panels and missiles, you need refining. And guess where the vast majority of that refining capacity sits? It sits inside China. Even if silver is mined in Mexico, it often flows through Chinese processing infrastructure before it becomes usable industry-grade metal. China controls the bottleneck, and this bottleneck creates a paradox that most Western politicians are too blind to see. Here lies the ultimate irony of the Western agenda. We call it the green trap. For the last 5 years, Western governments have been obsessed with the green transition, trillions of dollars in subsidies to force the world into solar and wind. But nobody in Washington or Brussels bothered to do the math on the periodic table. You cannot have a green transition without silver. It is physically impossible. Silver is the second most conductive element in the universe. And here is where the trap snaps shut. The solar industry is shifting technology. We are moving from the old PERC cells to the new TOPCon and HJT cells. These new efficient panels require 50% to 150% more silver per unit. So, the West is printing trillions of dollars to subsidize a solar boom. That solar boom creates a massive deficit in silver. And who controls the silver processing? China. Do you see the loop? The U.S. Federal Reserve prints money to fund a policy that directly enriches the strategic rival they are trying to contain. Every time a Western politician gives a speech about net zero, the price of silver in Shanghai ticks up another $1. We are literally funding our own siege, and China is happy to sell us the rope, or in this case, the solar paste, at a premium. And this structural shortage leads to the final nail in the coffin. I call it the miner's revolt. Put yourself in the shoes of a silver miner in Peru or Mexico. For decades, you sold your silver to the Comex or London markets at the spot price. You let New York dictate the value of your hard work. But now, you look at the screen. New York offers you $72. Shanghai offers you $78. And more importantly, Shanghai is paying in gold-backed yuan or offering immediate settlement, while New York plays games with paper contracts. What would you do? Rational economic actors will bypass the Western exchanges entirely. They will ship directly to the refiners in the East to capture that premium. This creates a death spiral for the Comex. The physical metal bypasses their vaults. Their inventory drops even lower. The leverage ratio, the number of paper tickets per car, explodes. The trust evaporates even faster. China isn't just buying silver. They are forcing the entire global supply chain to reroute. They are building a new gold corridor and a silver corridor that completely bypasses the US dollar system. The West is losing the physical flow. And once you lose the flow, you lose the right to set the price. You become irrelevant. So when you see the price drop on your screen, don't panic. That is just the paper market throwing a tantrum. The real market is moving east, and it is never coming back. Now, I know what some of the skeptics are thinking. I can hear the comments section already. Some of you veterans might be saying, "Robert, we've seen this before. Remember 1980? The Hunt brothers cornered the market, silver hit $50, and then it crashed back to $5. This is just another bubble." You are right about the crash, but you are dangerously wrong about the cause, because you are comparing a casino raid to a structural shift. In 1980, the Hunt brothers were speculators. They bought silver on leverage just to squeeze the price. The price crashed because the demand was artificial. Today is the exact opposite. China is not buying silver on margin to flip it next week. They are buying it to use it. Once that silver goes into a solar panel or a missile guidance system, it is gone. It is off the market for 20 years. It doesn't come back. This is not a speculative bubble. This is a structural deficit. In 1980, we had too much money chasing a pile of silver that was just sitting there. In 2025, we have too much industry chasing a pile of silver that is rapidly disappearing. The floor has changed, and if you are waiting for $15 silver to come back, you might as well wait for 50-cent gasoline. So, with the history understood and the mechanism exposed, how does this end for you? We are moving toward a great repricing. For decades, the West has enjoyed a privilege that is now ending: the ability to print paper money to buy finite physical resources at suppressed prices. But when the Shanghai price stays $6 higher than New York, the game is over. This leaves you with a binary choice, and you have to make it today. The next decade will be defined by one simple dynamic. The East is draining the West. The physical molecules, the silver, the gold, the copper, are moving from New York and London vaults to Shanghai and Mumbai. The West is left holding the empty receipts. So, look at your portfolio. Are you holding the ticket, the ETF, the futures contract, the paper promise? Or are you holding the car, the physical metal that you can actually hold in your hand? Because when the music stops, and the music is stopping, the ticket holders become creditors in a bankruptcy court. The metal holders become the new banks. Don't be a creditor, be the bank. Tell me in the comments, do you trust the $72 paper price or the $78 physical price? I'm Robert. The ledger is balanced, class dismissed.